COVID affects multifamily significantly. Like with evictions, moratoriums, rent stimulus, cancel rent, rallies and things, all kinds of stuff like that affects that.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hi everyone, this is Agostino. When you get into multifamily, you're going to find that it's going to be a very broad business, a very broad field. And I think that for many people that get into multifamily, it's very, very exciting. But I think what it does is it also opens up opportunities to get into other asset classes, right? And today's guest understands this. He actually leads the largest global networking community, MultiFamilyMasters, that can be found on Meetup and as well as other places. He's GP'd in about 1,000 units at this point. He actually closed his first self-storage business a short time ago, attesting again to that expansion outside and beyond multifamily. So I'd like to introduce Powell Chee. Powell, thanks for coming on, bud.
Hey, appreciate it, Agostino. I'm happy to be here.
Yeah, I think it's going to be super. Now, if you guys want to reach out to Powell, if you guys like what he has to say, you can reach him at multifamilymasters.com. So Powell, maybe tell the listeners a little bit more about you and what you're about.
Sure, absolutely. So I definitely appreciate being on your show here. So my name is Powell Chee. I live in Los Angeles, multifamily and self-storage investor. Now I can say I'm a self-storage investor. I used to just say multifamily investor. Like you mentioned, I lead a group called Multifamily Masters. I like to say we're the universe's fastest growing meetup group. And, that's kind of our tagline, but I just throw that out there for fun. And I live in LA, but all my investments are out of state. You did mention I've been GP on about 1,000 units in different syndications. And so all my investments out of the state of California, all kind of spread out throughout the United States. And then most recently have, like you mentioned, been working on a self-storage deal that was able to close.
Excellent. So let's talk a little bit about your multifamily journey first. So I know you're in LA and you started buying stuff out of state. So how did that work? How did you do it? Who'd you partner up with? And really, what was your mindset when you first started making that leap from where you are here in, there in Los Angeles to outside? I mean, because I know that so many people right now, they're in your shoes. They're in California. They want to make the leap into real estate or even multifamily, but it's very, very tough to do if you're in California.
Yeah, I know. Initially, that was the very first thing was that I realized that you could invest in real estate outside of where you live. Right. That was a huge revelation to me, because at first I was very stuck in the idea of like, how am I going to do this? I live in California, I live in LA, or I lived in the San Francisco Bay Area at the time. Housing prices extremely, extremely high. How am I ever going to save up for a house and then do, whatever, fix and flip it or whatever I was going to do with it, right? And it just kind of got me stuck. And then I really started listening to a lot of podcasts, reading a lot of forums, books, and things like that, and started hearing from people that were investing in places they don't live in, or they bought something and then they moved, their job moved them 1,000 miles away, but they still have that place that they're renting. And I thought, wow, people can do this? So I was super excited. Ended up buying my first single family house at that time. It was 2015. Single family house in Kansas City. Still lived in LA. And that was eye-opening because it was successful. It was doing well. And I was like, wow, this can really happen, But I just realized quickly after that I needed to scale faster. I just didn't want to do the single family route just the way I was going. I just thought I needed to scale a little faster. So I just kind of translated that to multifamily. So I bought my first multifamily about a little more than a year after that. And that was in Indianapolis. And that one was the one that I structured by myself. So I wanted to do it by myself. Didn't really want to bring in investors. I didn't really know any investors necessarily that I could reach out to. But I just thought, hey, I'll do this by myself. That way it's my money. And if I mess it up, who do I have to blame? Really just me, right? And nobody's worried about their money and me having to, have to repay people or anything like that. It's just alleviate that pressure. I'll just do it by myself. So, did that one. January 2017 is when I closed that one. About a year later, I did another one in Indianapolis as well. So I did another apartment in Indianapolis. And that one I did with a joint venture. So at the time I thought, okay, now some people know who I am and they kind of trust me as a person and they want to invest with me on a multifamily deal. So I did it with a small group of people, 5 or 6 people. and that was January 2018, right? And then it took me about another year. And during this other year, I started meeting more people, started gaining a little bit more experience with others and what they were doing, and just more background, more socializing and network growing. And then I started moving towards syndications. So, and then in 2019, I got involved in 5 different syndications as a general partner on all of them. So that kind of, it gave me experience from having my own to a joint venture to now heading into syndications where it's, where you're more specialized. It's a larger piece of the pie, right? So it's a larger property, but you're doing sort of a specialized niche work on it as a general partner, right? And so that's what I did for all of 2019, and then 2020 came around, and I was looking to continue to do syndications, but obviously the world sort of shifted at that particular point, right? Early 2020, and COVID happened, right? And then COVID made me rethink a lot of kind of what was going on. And so during that time is really when I got a chance to reevaluate what I was doing and explore other options, like you mentioned in the very beginning.
Yeah, excellent. Those other options, of course, is self-storage, right? The self-storage business, which is very, very different than multifamily. I did some research into that business some time ago too, and what I learned anyway is that Americans love to keep a lot of stuff. They don't want to sell it. We know that. And, in other countries, like say in places like Colombia and actually anywhere in Central or South America, or even in Europe for that matter, there's no such thing as like a self-storage, or if there are, it's very, very limited in terms of business. But here in the States, there are many of these businesses. But it's exactly that. It's a business, right? So I think positioning yourself, logos become way more important, advertising and all that stuff, right? So I'm guessing that for you to make that leap, you have to really learn that business and figure out, like, what am I going to invest in? How am I going to make this expansion beyond multifamily?
Yeah, exactly. So when COVID happened, I did exactly what you said, right? Storage was probably my second option the whole time that I'd been investing, but I'd spend 95% of the time on multifamily. So when it came to storage, I really didn't know what I needed to know. I didn't know how to evaluate a deal. I didn't know how to underwrite a deal. I didn't know what makes a good deal, a bad deal, and what things to look for. But I now had the time because like I mentioned, that all of my investments are out of state, and generally pretty far away from California. Like the closest one from me is probably Phoenix. After that's Dallas. But because I'm so far removed from my properties and the areas that I'm investing in, I don't have as tight of a network in one specific area. So when COVID happened, the people that were able to start pick up like really good deals or see something that was a great opportunity were probably those that had, they knew their area really, really, really well, right? And based on my business model, because I'm spread out, I don't know every single place. I don't, know that city really, really well compared to those people. So I knew from there, I said, I'm going to pull back. I'm not going to buy anything for at least 6 months, multifamily wise. I know I'm not going to buy anything multifamily wise for 6 months. Eviction moratoriums, rent cancellations, stimulus bills, all of these question marks just made me say, okay, pause on the multifamily for at least 6 months. Now, instead of just sitting around doing nothing, I said, well, now let me just go look at storage because I like this asset class. So let me think about it, or do some evaluation, do some reading, do some research, get some coaching, right? So I did all that, right? So I do all the things that you do in multifamily when you're learning, you're listening to podcasts, you're reading, you're paying for, different people's analyzers, or you're finding out how to evaluate these deals and how to, what the ins and outs are with storage. And that's what I did. Spent all that time to do that. And then pretty quickly I decided, hey, you know what? I think this is an asset class that I will like to do right now. And even during times of COVID, that I will start putting out offers, right? Contacting brokers now. And now I've done the education piece of it. Now let's start to potentially buy something. So did that whole process and was able to put a deal under contract in think that was October, and and then recently closed on it. But yeah, I mean, that whole process was, like you mentioned, a lot of learning, a lot of finding out what you don't know, how to evaluate deals and what makes a good deal, and then how to move forward with that, right?
Nice. And so let's talk a little bit about getting it under contract then. So did you actually do it on, like, get it under contract on your own, or did you and then line up any partners afterwards? Did you already find some partners, someone maybe that had some notoriety in the self-storage game or anything, or what?
Yeah, so no, I didn't. I didn't particularly use any like any group, the self-storage group or anything like that. I have a fairly extensive group of network like already in multifamily, right? And I knew that a decent amount of them were interested in anything that makes sense, right? Not just multifamily, but anything that really makes sense. So I knew that they would be open to, say, storage. Now, I didn't know that all of them would be open. I knew that some of the people would be open, right? And so for the first deal, I just decided I'm not going to syndicate this deal. I'm going to make it sure it's a smaller deal. So the deal was, fairly, I would say, it's not a huge deal. It's not a small deal in terms of the numbers wise. It's on the smaller end, right? I bought it for $675,000, right, which is not that much compared to syndications where the lowest one, were $10 million at least, right? So not a big raise, not a big purchase price. However, it's not considered a small deal. It's kind of in the mid-size. It's 20,000 square feet. It's 175 units. So it's got some weight to it. But because of the size and because it was not a huge raise, I knew I was going to be able to bring in some partners that had enough capital that we could go take this down in a small group. I only needed 4 or 5 people. And I knew that I could count on 4 or 5 family members or anything like that. They're probably not even into real estate that much. They probably just trust me more than really knowing much about the deal, right? So they said, okay, yeah. So I basically reached out to 7 people. First of all, to answer your question, I found the deal, and when I was pretty close to getting under contract, so the conversation with the seller was going back and forth, like we were getting pretty close on our numbers. So I knew this was probably going to happen. That's at the point where I contacted my network, right? So I reached out to 7 people, and 6 of them said yes. And so, I knew that at that point I was like, okay, yeah, we'll have enough money easily to do this deal. And most of them they're just friends and family, just tight group. I didn't tell my whole network because most of them know me as a multifamily guy, and I didn't want to say anything to them about what I was doing. I just wanted to, keep it kind of tight to the vest to a small group first, explore the options, and then we'll see what happens after that.
Right. And you said this it's like a joint venture, so it's structured a little bit differently than the syndication thing. So how's the structure set up, the joint venture, if you're able to share it anyway?
Yeah, sure. I mean, we model it off after. We model it very much like a syndication, right? So that we break it down into 3 distinct sort of pieces, right? Acquisition phase, there's the acquisition phase. And so that's a third of, say, the general partnership, or the joint venture, right, of responsibility. A third is for the capital side, bringing in the capital. A third is for the operations, who's going to run it afterwards, right? So the joint venture is kind of broken up that, and people have different responsibilities within there, and they could have multiple responsibilities in those 3 different categories. So that's how it's all kind of built out, and in a similar structure that maybe many people have seen as with syndications, right? So yeah, but it's just a little smaller group, right? Just kind of like try to make it as familiar to them as possible, because like most of the people are coming from sort of a syndication understanding of familiarity with syndications. So I built it to be similar to that as well.
Well, and I think that's a smart way to do it too, especially on a smaller deal, because they understand the syndication model, but to try to syndicate such a small deal would be very, very expensive, very time consuming, with the SEC and all that fun stuff. And as long as everyone understands what it is and their role that they have to play, there really shouldn't be any issues. And as like I said, it's all friends and family, right? So it isn't like you're publicizing this in the market or anything else like that. So it's a very different setup. Very different setup.
Yep, exactly. And so I do like the model, because now what's coming about is that the people are realizing that they're actively involved. So there's no passive investors, right? There's no people just putting money in, don't do anything, right? There's people who do less, there's people who do more, but there's nobody that's just like has no say in it, right? They all have voting rights, they all have access to everything, their communications there to everybody. So they actually, a lot of my joint venture partners are extremely excited and very grateful, or I don't know, grateful, but they're happy to be in this deal, because they're seeing things that they haven't seen before, even on other times where they're general partners or other joint ventures or other limited partner experience. They're seeing things that they've not done before. They're getting experience where they have not got before. They're involved in these conversations. They're involved with the decision making a lot more than they've ever been before. And so they're gaining all this experience, so that if they want to go do a deal on their own, hey, that's cool. They learned from me and were able to do a deal on their own. Go for it. If they feel like that my setup is good and they like my team, they can come with me on a different deal, right? So I think they've and I've tried to structure it like that, so that they're getting something that is different, right? This is a joint venture, a small group that I'm running with my business partner, but it's not just a typical syndication that they may have seen or may have been involved in. So I try to make it a little bit different for them and get the experience a little different for them.
Yeah, and I mean, not that we're giving all legal advice here, but when you're doing a JV, those other partners, because this is exactly what they are, they're partners. They have to have a role. Otherwise, the SEC, if there ever is an issue, heaven forbid this problem, then they had a job to do, and they're assigned a job. It's not passive, just as you pointed out, which is critical, because once it becomes passive, now you're selling a security. So we don't. Today's show's not about securities, but I'm just getting it out there for people that are listening that a JV is indeed different than a syndication. Yeah.
Yeah. Everybody's active. Which you also got to point out too that everybody is also liable. So this is a part that was sort of the downside of a JV, right? Because everybody's liable. Because if you're a passive investor on a syndication, you're not as liable as the active partners, right? So on this, everybody is liable, and everybody has to take responsibility for that. So you got to let people know that up front. Right? I let all the partners.
Yeah. There's that as well. But I mean, I can't imagine that on a self-storage type of deal, you're going to be really prone to any type of issues. But knock on wood. I mean, never know.
I know. Let's keep it that way. Yeah.
Right. So I guess I would venture to guess if someone listening right now has questions about well, if multifamily is so good, then why do you guys have to go off and do other things? People have asked me that. We have many doors ourselves now that we're getting into redevelopment. We're doing triple net. We're doing other asset classes as well. And the reason why we do it is because we want to offer our investors alternate ways for them to make money, right? In the world of triple net, for instance, it's very different than multifamily. Triple net allows for a very slow, consistent growth because the lease is corporately backed. There's a corporate guarantee behind it. So it may not be like the wild cash on cash return as say a multifamily, but it is guaranteed every quarter. That money's going to come in no matter what. So anyway, that's the reason behind what we do. And we want to offer our investors a variety of different things. Now, why did you look to expand beyond just the multifamily game that you're doing today?
Sure. So I mentioned a little bit with COVID, right? So COVID affects multifamily significantly, with evictions, moratoriums, rent stimulus, cancel rent, rallies and things, all kinds of stuff like that affects that. Plus there's human interaction, right? There's a lot of human interaction, right? Storage is much more sort of doesn't have as much of a human element to it, or it doesn't have to have as much of a human element to it, right? It can be a lot more like you mentioned, your website is super important, right? Your people are finding you on your website. Multifamily, they're not necessarily finding you on your website, right? They're not looking for your website to go figure out if they can rent from you. In storage, they are, right? And your digital presence is significantly important, right? So there's less of a barrier there. And you don't have that daily human to human interaction, right? Your tenants can come through the gate. They don't have to, see anybody. They just go straight to their unit. They pick up their stuff. They leave, and they're not necessarily there every day, right? They might come once every 2 months or something, right? They don't, there's no need for them. So there's not that much traffic coming in and out. So not as affected by COVID as much. And you actually have a lot more ability to go to do everything digitally and do everything online, which is our strategy. So even though we have an office, we're actually not going to use that office, or we're going to rent that office out, or we're going to do something different with that office. We're not going to have an employee in that office. We are going to have everything digital. So everything's digital. You do it online, or you do it on the phone, right? And then a person can just just go in. They don't really. It's pretty self-explanatory. Just go to your unit that has the number on it, right? After you sign it, you sign the thing online. So it's pretty easy, and most people are more adapted now to doing things online and not having to do things person to person. So it's much more, I would say, we've taken a few steps towards that sort of digital, doing everything digital, as the world since COVID. So that's why I say that, like, I started to branch out with this, and I would tell you also, in terms of like why joint ventures, maybe that's also a question of like why joint ventures versus syndication, because yes, I could have done a syndication instead. Is truthfully, my network this fits my network a little better. So my network is now really composed of people who love real estate, right? They just love all kinds of real estate. They want to learn all different types of real estate. The second is that they probably have some capital. They probably have either a job or some business where they have some capital saved up. And the third thing is that they want more experience. They want to gain the experience side of it. So they're not looking to be just purely passive. They want to be involved. And that's generally what my network is right now. So this just fits my network, doing a joint venture of people who love real estate. So they're open to other asset classes. They are, they probably have some capital saved up, and they also want to be actively involved, right? And so,
yeah, well, it's funny because that's one of my basic rules is before you even get a deal locked up, to know where the money's coming from. Where's the lender coming from? Where's the investor money coming from? And that's exactly how you do it. So it's kind of interesting that you do it the same way. It's not the old, just get it under contract, the money will come. Yeah, it's a little more than that. You still have to know where the money's coming from, but
I think that's super important. I agree with you there. Sometimes that gets glossed over at times where people just, like, I'm looking for anything from a 10 unit to like a 250 unit. I was like, that's a big difference. You need to know where your money is going to come from, right? Because 250 units, you need to know where that capital is going to come from. That just doesn't just show up. You do have to work to get it. I know there is capital out there, but it's like,
part of the network. Need a network for it. And that's another brilliant thing you just said too, is that you're matching up the network with the investment. And that part is huge. Again, that's often overlooked. Some investors, all they want to do is multifamily. Some investors, they just care about a return. They don't care what it is. Some investors love doing triple net. They love the triple net. They love the consistency. They don't care about the big bang every at a refi event or whatever. They just want that consistency. Maybe they're a little bit older and they want to know that money is coming in. But yeah, I mean, I respect that. I like that your investors are looking for those alternate asset classes because they want to learn how to get into these other asset classes. That's great. That's super. Good way to put it together. And getting back to the self-storage thing, I know you said you're going to apply a lot of digital strategy to it. When I was researching it, I also saw and found that there's a lot of automation that can be done for those units too. So meaning that for someone that wants to rent a unit, they literally don't have to talk to anybody. They walk up to a kiosk, they can sign up online, sign up at the kiosk rather, sign for it, swipe their card, grab a lock. It tells them what door to unlock. They go over there and away you go, right? It's brilliant. Talking about that.
Yep. And I mean, now, like, I would say that technology is further advanced in self-storage than it is in multifamily. I mean, just like you mentioned, you can do all of that online, digital kiosk system, a number of different ways. But you can also, now they have Bluetooth locks, right? So your whole place, it's wireless, right? You have an app on your phone that can, get you in the front door, and then your app unlocks your unit. And then also, if you don't pay, we can lock all the units, right? If person doesn't pay, because you have these Bluetooth locks, right? So that's all out there. Plus, there's a lot more, I would say, dynamic pricing. So everybody's probably seen dynamic pricing with like airline tickets and things like that. They go up and down depending on what day it is and how many sold in that day and how close you are to the actual flight. Well, the same thing is true in storage, is that your rent could go up and down. If you have a lot of units, then maybe your rents goes down a little bit, so you can rent out a little. As you get close to filling them out, they start to go up in price. And then they're reading different websites and they're basically aggregating all that information from all the different local areas and figuring out where we should go up or down, and it's all automatic. Whereas in multifamily, it's not really like that, right? I mean, you might change your rent once a month. If you change your rent price once a month, that's maybe pretty often, right? You're not really doing it necessarily dynamically. You're just kind of, asking the neighbor what they charge, and you charge about the same, right? Okay.
And that's basically, I mean, if the property manager's doing their job, they're checking on a quarterly basis with what the neighboring communities are doing, and then somehow either match it or something to that effect. But you're right, though. It's a very active way to manage a multifamily business as opposed to the self-storage business, where it's all very dynamic. Technology is making the decision. So it isn't like you have to worry about someone not doing their job. The system is handling the whole thing. Yeah.
Yeah. It's strange to think of storage of being a sort of a technologically based, or technologically fairly advanced, industry, but it actually is. I mean, like it's, compared to a lot of other real estate that I've been involved in, it is just more advanced as an asset class.
Yeah. So now what's next then? Are you going to take on more of the self-storage business? I'm guessing you must really like it so far. I mean, I know you just got into it, but you think you might be doing more of it?
Yeah, I'm actively pursuing more right now. So I do have some good leads on some other properties as well. Probably just moving up a little bit in terms of purchase price. So this one being my first one was a little on the small end. I'd like to get to, right now I'm looking at properties that are in that sort of $2 to $3 million range. So I can still do it with a joint venture, but I can also I can take advantage of some of the loans that are maybe $1 million loan amounts or above, right? Whereas if you're under that $1 million threshold, you're sort of limited in terms of what types of lending you're getting. And I would say that is one of probably the biggest hurdle / obstacle that I have faced, is the lending side versus multifamily. It's much more of a scattered, non-uniform, figure it out from each individual institution, and it could be all over the place, right, in terms of the lending.
So it's a little tougher then too, I would imagine, because of that, right?
Yep. It's a little tougher. There are some good options, out there. So like you can do SBA lending, so you can do small business loan lending. So you can get government loans for storage where you cannot for multifamily. But it's still, it's not purely straightforward. It's not just the easiest to get. Sometimes it can be a little more difficult. And still, when you're working with a number of different banks, each bank has their different terms, has their different different requirements, different things they want to see, right? They want to see a lot more of you personally and what you are doing personally than they do in multifamily. When you're doing syndications, they're looking a lot more at the property and the building and you as well, but not as much. Whereas in this, if you're dealing with little, banks and local banks, they're looking at you a lot, right? I mean, they're really scrutinizing you.
That's right. I mean, and that's also where you get to leverage some of the experience as a GP on the multifamily side too. So if anything, you get to use that experience, use that resume to get into those other assets, and you don't look like a quote newbie, when you're taking on something new. right?
Yeah. Truthfully, I thought it would be more welcoming than it was. It was still very much like, mm, yeah, that's good, but you still haven't done it in self-storage. I still got a lot of that, and I thought there'd be more. I thought they'd be more accepting, but you know, it is what it is. You know, like I said, it's still an obstacle, it's still something to get over, but yeah, it is a little bit tricky, a little more tricky than I would say multifamily is. And not every lender likes it. Truthfully, not every lender likes storage. I think it's a great asset class, but there's some lenders you go to and they're like, you're going to have to put like 40% down, I think, on this property. I was like, whoa, really? You must not like this property. You must not like this asset class because you're asking to put 40% down. SBA asked us only put 10. So you want us to put 40? Okay, so there's a big difference here. So you must really not like this asset class.
Yeah. Well, but you know what though? It's the same thing that I actually talk about I've talked about it on previous shows and my coaching. All that is that if you have a credibility book, if you have a resume that talks about maybe other assets that are very similar to what you've done, or someone on the team that has done it, it makes life that much easier to get an audience with one of these brokers. That's what I was asking earlier. It's like, hey, did you do it on your own? Or did you get someone in the know, so to speak? So it's great that you're able to pull it off on your own. But now it's getting that first deal. It's the same thing in multifamily. Getting that first deal is always the toughest one. And it gets easier and easier and easier as you go, right? Yeah. Do you see yourself moving beyond the self-storage business anytime soon, or what?
I got some good momentum right now in storage. So I feel like that I kind of want to strike while the iron's hot right now. I have some, like I mentioned, some good leads on some other properties that I'm working on. So yeah, I would like to, before I start looking at other asset classes and really evaluating there's a lot inside of storage that you could do. So just so I guess people understand, like what I bought was a standalone facility. It is what it is. It's really a management play in terms of the value add. It wasn't managed well before. I think we could do a little bit better of a management job, but there's no expansion, there's no growth or anything like that in terms of the size of the property. But that is a possibility with other properties, is that there's land next to it, right? Or there's open space next to it. So now you can expand. So that's a value add piece that is a lot of people look for. And I look for that as well. It's like looking for land or open space that you can add additional units to. And the third part of it is really the similar to the development side, like you mentioned, is that there's conversion of opportunities. Whereas there's old retail stores or old Kmart or old, whatever it is, some type of big box building, right? That big box building has maybe been abandoned for a while. You can probably pick that up for pretty cheap, right? And then convert that into, like climate controlled indoor storage, right? And that's a whole nother option. Now, I haven't done that, but these are things that I'm definitely looking forward to doing. Some of the leads that I have right now are on a little more expansion play. So it's learning about expansion and zoning and getting those approvals through the city and being able to build like that. But eventually I'd like to do some conversions as well to, take an old warehouse and convert that warehouse into a multi-level self-storage property, right? And not have to put up the money to build that building, and actually just buy it kind of on the cheaper end, right? And then convert it. So I think there's still a lot of runway with storage. There's still a lot of runway and there's still a lot of possibilities. So not looking just yet, not close to the idea, but I am kind of sort of trying to keep the eye on the prize on with storage right now.
Excellent. Well, I love the focus. That's one thing that I often recommend to everybody is like pick one thing, focus on that one thing, build it up, automate it, go do the next one right afterwards. So it's perfect. All right, Powell. So if you had one piece of bulletproof advice for someone listening right now, what would you tell them?
Yeah, I would tell them in general, like I mentioned a little bit about the 3 different areas that that are part of a syndication or part of a joint venture that we've created. I think it's great for people to understand what is their strength in there, right? So understanding what is your strength that you can bring to a team. If you're going to buy a property by yourself, you're going to have to do all 3 of those, right? Acquisition, you're going to have to do the acquisition, contracting, negotiations, due diligence, and then you're going to have to, raise the capital or find the capital or whatever, borrow the money. And that's the second part of it. Or the third part is you're going to need to run that deal and make sure it is successful for the next 5, 10, whatever, however many years you hold the property, right? But if you're going to do something involved with a team, then to think about it as what is my strength, right? Where is my strength at? Is it on the acquisition side? Can I really help out with finding more properties? Is it more on the capital side that I have a network of people that I can raise capital with? Is it on the operations side where I'm really good at running these and project managing and being successful with operations, right? And I think that if you know where you're at, you can know where you want to focus and get really good at and bring that value to any team, whether it's multifamily, storage, whatever type of team you want to get involved with.
Excellent. Very sound advice. I often tell people the same thing, bring your gift to the team and become very, very good at it to help offset the weaknesses that other people on a team might have. And that's how you put together a strong team. I absolutely love it. Thanks for tuning in, guys, and I'll see you in the next episode. Take care.